This first hearing of the Financial Institutions and Consumer Credit Subcommittee and the 110th Congress addresses a critical and escalating issue. We are facing, by all accounts, a tsunami of defaults and foreclosures in the primary subprime market. In each of our districts, our constituents are encountering payment shock as their initial teaser rate ends and their loans reset to a higher rate. This is happening at the same time homeowners are having a more difficult time refinancing because their homes are no longer increasing in value. So they are defaulting and going into foreclosure and losing their homes. Every analyst says that the third quarter of this year and the fourth could be even worse than the rates of default and foreclosure that we have seen. By some estimates, 2.2 million homeowners with subprime loans made through 2006 will lose their home. As this chart shows, rates of default and foreclosure, which were decreasing, are now on a sharp increase. We also have a dramatic increase in the number of subprime loans being packaged into securities, from less than 8% of the market in 2001 to 20% last year, a more than doubling in 5 years. In the last month, a very significant down market correction is taking place in the secondary market. Yesterday, for example, Morgan Stanley announced it was auctioning off almost $2.5 billion worth of subprime mortgages from New Century, one of the largest subprime lenders. At least 4 large subprime lenders are already in bankruptcy. The debate has moved on to whether the turmoil in the subprime market will infect the larger economy. Against that backdrop, this hearing takes on as its starting point the proposed guidance on subprime lending jointly on March 2nd by the 5 banking federal regulators, all of whom are testifying today. This guidance has been endorsed by the Conference of State Bank Regulators. The guidance is simple, common sense. Do not make loans people cannot repay. It sets out principles for lending, which require lenders to assess a borrower's ability to pay over the whole life of the loan, that is, whether they can pay the loan at its fully indexed rate, assuming a fully amortized payment schedule. Guidance requires proof of income and ability to pay, no-doc loans, or as they are called in the business, liar loans. At the same time, it allows for flexibility and underwriting for those who may not have the traditional indicators of good credit. This guidance tries to strike a balance. We want to maximize the dream of home ownership while minimizing closures. This is the first in a series of hearings planned for this topic. With legislation in mind, I have questions for both panels that go beyond the guidance itself to what I consider the larger picture. As the chart shows, only about a quarter of the primary market in subprime loans is directly regulated by the federal banking regulators. Another quarter, consisting of mortgage subsidiaries of holding companies, is indirectly regulated by the Fed, and about consisting of state-regulated banks and finance companies is regulated by its work of state laws. Assuming the proposed guidance goes into effect for the federally regulated quarter of the market, how can it reach the other 3 quarters? That is the essential question of this hearing. Some suggestions have been made, and I would like the witnesses to comment on them. First, as federal officials have said, and as Senator Dodd has pointed out, the Federal Reserve has broad powers under HOEPA, the Home Ownership Equity Protection, to regulate unfair and deceptive practices for all lenders. Should the Fed use those powers to extend this guidance to the entire market? I understand that some of the regulators support such a move. Secondly, who could enforce that for each of the different sectors? Also, what about the suggestion of extending the Fed's regulatory powers to the mortgage subsidiaries of bank holding companies, so that quarter of the market also has to follow the principles of the guidance? And next, what about the state banking regulators? Can they act to promulgate the principles of the guidance nationwide? Or should we have a national subprime tracking the guidances? And if so, who should enforce that? I am interested in knowing and how to extend the guidance to the secondary market. Lenders will not make these loans if they cannot sell them. I believe the GSEs, as leaders in the secondary market, should stop buying loans that do not conform to the guidance, as Freddie Mac already done. How do you think we can best extend the principles of the guidance not only to the GSEs, but also to the other secondary market participants? Finally, what can we do to help current borrowers in a responsible manner? The regulators have encouraged lenders to exercise forbearance, but how do they plan to implement that policy, and can Congress help support that effort? I know that Senator Dodd is calling together many of the participants to come forward with a plan. These are pressing problems requiring prompt attention. Of course, we wish the regulators had acted sooner. I applaud them for having taken this first step, and I look forward to their testimony. I now recognize the ranking member, Mr. Gilmore, for 10 minutes.
I'd like to thank the chair for calling what is a very important hearing today, and also I'm delighted to see such a distinguished panel, and I look forward to working with the chair, with others in